Let's talk about VaR, or value at risk. It's the most widely used metric to calculate market risk. It tells you for a certain confidence level how much you are going to lose for a period of time. For example, we are 95% sure that over 10 days we are not going to lose more than 5 million, but it has its limitations, and there are multiple reforms to improve it or even replace it. Let's take a closer look. The most widely used metric for measuring market risk is VaR, or value at risk. In the case of banks, it has been used since the First Amendment to the Basel I regulation in 1996, so it has been used for more than 20 years by now. And value at risk simply is a statistical measure that dictates for a certain time period and a certain confidence level what is the maximum loss within those conditions. For example, saying over 10 days with a confidence level of 95% we will lose 50 million maximum. It provides an answer to the question, how much can we lose in this portfolio or fund in the next day, next week, next month, next year, or any period of time? As we'll see, the biggest shortcoming of VaR is that it does not estimate losses outside the confidence interval. For example, if you are 99% confident that you are not going to lose more than 50 million, there's 1% remaining. But what can happen in those 1%? Anything. That's the problem. So that's one reason why it's common for risk managers to estimate multiple values at risk for different confidence intervals. 95%, 99%, 99.9, and so on. If you imagine a normal distribution, a Gauss curve, then VaR is setting two vertical bars that are almost on the extremes, but they're not at the extremes, and capturing all of the distribution between those two bars, which is almost all of the distribution, but not all of it. It doesn't capture those two small extremes on each side. VaR has multiple problems. The biggest and most obvious one is that it doesn't include losses outside the confidence interval. So in our example, we have a 95% confidence interval, and we lose, at most, 50 million in those 95% of situations. But what about the remaining 5% of situations? What do we lose in those cases? It can be 5.5 million, it can be 500 million, it can be 2 billion. There is no way to tell. This is the biggest limitation of VaR, and the reason why one analyst, in a very funny analogy, called VaR an airbag that only works when you don't have a car crash. In other words, it's useful for everything except the extreme scenarios, and it fails miserably in those. Another possible failure is that VaR is based on historical data. More accurately, there are multiple approaches to calculating it, but most institutions, such as hedge funds and banks, calculate it from historical data. So VaR can be manipulated by selecting time periods that are very short or that are very bullish. Another problem is that VaR averages out internal risks. For example, if you have 500 million in a big long position and 500 million in an opposite short position in another portfolio, these risks are averaged out. Sure, you may be hedging, but the risk is not zero. VaR will consider it zero. Also, VaR becomes very hard to calculate with a large number of positions or funds, especially if they are correlated. For example, it was not good at calculating the correlations of asset-backed securities back in the Great Financial Crisis. So most banks thought that the risk was a lot lower than it actually was. And finally, the assumptions that are modeled to calculate VaR can be too simplistic. That is, we can assume that a certain market price moves in a certain way, but we may not capture other factors which can also cause risk. Technically, this is a type of modeling risk, but it applies perfectly here. Specifically, in the banking world, there is a tendency for banks to be very positive in their estimations and to not account for negative times, and this includes VaR. If VaR is calculated using historical data that is too positive, for example, then the risk will be underestimated, naturally. So regulators have started to demand what is called stressed VaR, stressed values for value at risk, which represent negative market times. In the Basel III framework, banks that use what's called the internal model approach, where they calculate market risk themselves, must calculate what is called stressed VaR, as we mentioned. In short, every time that the standard value at risk is calculated for a portfolio or a group of positions, in parallel, a stressed version of that VaR must also be calculated, and that parallel version, which is stressed, must take into account historical data from a 1-year period of significant market stress. And that period should be one that is very negative for the bank. Sure, it can be 2007, 2008, in the peak of the great financial crisis, but it can be an even worse period if it exists. So for example, let's say that a bank has an equity trading desk. It must calculate the vanilla value at risk for that equity portfolio based on standard data, but also, in parallel, a stressed value at risk for that portfolio, gauging how it would behave in conditions similar to the great financial crisis or another period that you choose. The goal of this is to make banks hold additional regulatory capital that reflects times of stress. Although this is not required for institutions such as hedge funds, which are not banks, it's always a good practice in order to predict how bad times will affect the fund. Specifically for banks, due to the limitations of VaR, the Basel Committee, in the Fundamental Review of the Trading Book, or FRTB, which is an amendment after Basel III, actually suggests replacing value at risk with something called expected shortfall, or YES, which is also known as conditional value at risk. After more than 20 years using value at risk, regulators have come to the conclusion that VaR is not enough, even with stressed periods. So, what is expected shortfall? By definition, it's the average loss in excess of the loss calculated by value at risk for that period and that confidence level. Remember our initial example. We lose 5 million maximum in 95% of cases. But what about the other 5% of cases? VaR tells us nothing about those cases, but expected shortfall tells us the average of what we lose in those 5% of cases. It's important to note that expected shortfall does not calculate the worst case loss. It doesn't tell us in those 5% of situations what is the biggest loss possible. It just tells us the average loss in excess of the vanilla value at risk. So with expected shortfall, we know that we lose 5 million maximum on 95% of cases in our example, just like value at risk, and we also know that we lose 20 million, for example, on average on the other 5% of cases. It's one step further in loss calculation. So by definition, if you think about it, expected shortfall is a value that is always higher than value at risk because it includes value at risk, but it also includes the average of losses on the extremes. In terms of numbers, what happens is that banks usually use a 99% VaR, and after they implement the fundamental review of the trading book, they usually use a 97.5 expected shortfall. The 97.5 expected shortfall behaves exactly like the 99% VaR for normal situations and it also gives us the average for situations outside the interval. It's also important to understand that in terms of regulation, the fundamental review of the trading book requires that even more information be processed with expected shortfall. This is not due to the method itself, but the FRTB requires the expected shortfall to be calculated for 5 different liquidity periods of 10 days, 20 days, 40 days, and so on, and it must also be calculated for each individual trading desk and then summed up. And in parallel, the total expected shortfall is also calculated, and then both of these are averaged to reach the actual expected shortfall value that regulators require. It's a more diligent method, but also a very big complication in terms of IT and modeling infrastructure. What are some examples of VaR? The first is that VaR has a problem with big numbers, especially with funds. So VaR is complex to calculate for a large number of positions and also for a large number of funds, which is why investors, for example, that allocate to different hedge funds have a VaR for each fund but have no idea of their total VaR. The second is that VaR can be manipulated. Since it's based on a normal distribution, it can be manipulated by changing the distribution curve or the returns or losses within it, usually by manipulating the historical data. And finally, VaR and ES do have overlap, and 99% VaR corresponds to a 97.5 expected shortfall in all normal cases. For this interval, they behave in exactly the same way, but ES, besides what's within the confidence interval, also captures more tail-end risk, the extreme situations outside the confidence interval, which is why the FRTB demands this change, to have more transparency on extreme risks. What are our key takeaways here? The first is that VaR is the most widely known method to calculate market risk, and it simply answers the question of, for a certain period, for a given confidence interval, what is the maximum loss that we will sustain? Then, VaR has several limitations. They range from using specific assumptions, which may be wrong, to not scaling with complexity in a large number of positions, but the worst of all is that it does not estimate any type of loss outside the confidence interval. Then, for banks in specific, since most banks calculated VaR with historical data that was convenient for them, underestimating risks, the Basel III regulation has demanded, in parallel, for stressed VaR to be calculated using 1 year of stressed past data. And finally, to make up for the problems of VaR itself, the expected shortfall methodology is demanded by the fundamental review of the trading book. Expected shortfall is also known as conditional value at risk, or CVAR, and besides the losses in the confidence interval, it also estimates the average loss in extreme situations outside the interval. So as we see, value at risk is widely used, and it's very good within that confidence interval. The problem is outside of it. It can also be manipulated by manipulating the historical data, and that's why, depending on the Basel version of the specific bank, it can be complemented with stressed value at risk or even replaced by the expected shortfall methodology or conditional value at risk.